Welcome to the July 2014 edition of Financial Empowerment, a production of the California Society of CPAs and Cal CPA Institute. I'm Bill Spaniel. The California Society of CPAs Ask a CPA service frequently receives questions about 1031 exchanges, also known as like-kind exchanges. According to the Internal Revenue Service, whenever you sell business or investment property and you have a gain, you generally have to pay tax on the gain at the time of sale. IRC Section 1031 provides an exception and allows you to postpone paying tax on the gain if you reinvest the proceeds in similar property as part of a qualifying like-kind exchange. The rules for 1031 exchanges can be a bit complicated, so we decided to ask Los Angeles CPA Harlan Levinson to clarify things for us. We spoke to him over Skype video. Hello, Harlan. Welcome to Financial Empowerment.
Hi, Bill. Thank you very much.
We're going to be talking about 1031 exchanges, and for our audience, could you briefly describe what a 1031 exchange is?
Okay, a 1031 exchange is 1031 is a tax code section that allows you to transfer property without paying taxes on it. Mm-hmm. So it's a specific way to avoid paying current taxes, even though you might have a gain.
Great. And can anyone do a 1031 exchange?
Well, anyone that might have the right type of property can do it. You can do any if it's a rental property or an investment property, you can. If it's a property held for sale, for instance, inventory, or if you're a flipper of properties, then you would probably be limited in terms of the ability to do a 1031 exchange.
So what you're saying is basically rental properties or business properties? Is that what you're talking about as 1031?
Right. Also, personal property like your home is not eligible for the 1031 exchange as well. That's definitely excluded from this benefit. And vacation property sometimes can be used for a 1031 exchange and sometimes not. It depends on how much you use it for your personal use. If you use it a lot for your personal use, it's like a residence and not able to be used for a 1031 exchange. If it's more of a rental property that you use less than 14 days a year, then you probably can do a 1031 exchange on that.
Okay. And when you exchange, does the property you exchange for have to be somewhat the same property? In other words, if you're going to have an apartment building, can you only exchange it for another apartment building?
It's pretty wide. When it comes to real estate, real property, they basically say that real property in the U.S. is the same as any real property. So if you have rental property and you want to trade it to a commercial property, that is probably okay. You can trade it for property outside the U.S., and the restrictions on personal property are more specific. If you have a personal property that you want to do a 1031 exchange on, like a copyright or something like that, then you probably need to do a little more research than we can discuss today.
Okay. And how does a 1031 exchange affect one's taxes, or does it affect one's taxes?
Yes, I mean a lot of times people have bought property 25, 30 years ago. They've depreciated it, so it's got a very low tax basis, and now the price is high. So if they were to sell it outright, they would pay a significant amount of taxes. Even with the capital gains rate, they still would pay between federal and state, 30% or something like that in taxes. So by doing this 1031 exchange and assuming no money comes out to the people, to the owner of the person doing the exchange, then they can defer the gain until when they sell the property that they're transferring it into.
Mm-hmm. And I think you mentioned just a little bit earlier that you can do a 1031 exchange with foreign property involved. Is that correct?
Yes, foreign property can be exchanged for other foreign property, but it can't be exchanged for U.S. property.
So it's only foreign property that you own can be exchanged for other foreign property.
That's right.
And not for U.S. property or vice versa.
That's right.
Okay. And
a lot of people, they want to move out of they retire and they want to buy some property where they're living. That's not
Okay.
under this.
And when you do a 1031 exchange, does it have to be almost simultaneous, or can there be some sort of delay involved that you don't have to immediately exchange?
Yes, originally it was required to do a simultaneous exchange. Then, I don't know, 30, 40 years ago, someone got the IRS to agree to what is called delayed exchange. So that before you used to have to get the buyer of the old property and the seller of the new property all together. Mm-hmm. Now you can sell your property and use an accommodator or an intermediary to hold the money, and then you have 180 days to complete the purchase of the target property, the new property. And there are rules about the new property. It has to be identified within 45 days of the sale of the old property. And there's some other rules that need to be done. But the main thing is that the taxpayer themselves can't touch the money. The money has to sit in sort of like an escrow account with these intermediaries, the accommodators, and you can also do a reverse exchange. So sometimes people find a really good property, they want to get it, so they buy the new property and then they sell the old property subsequent to the purchase, and that's called a reverse exchange. That's allowed, but there are strict rules with that, and you have to use an accommodator to make sure that no money or boot, which is called not just money but other things, gets into the hands of the person doing the exchange, because once that happens, then you lose the tax-free benefits. There's also an improvement or construction exchange. So a lot of times people buy either raw land or it's a fixer-upper that they want to use as a rental property, for instance. They have 180 days to use the money from the old property to do any construction. To do that type of improvement exchange or construction exchange is more expensive in terms of fees you pay to the accommodator, because the accommodator is the one that's holding the money, paying the construction workers, the contractors, whatnot. So they have to do a lot more work. But it all has to be done within 180 days. If not, then you lose the benefit of the tax-free exchange.
Okay. We at Cal CPA have an Ask a CPA service in which people write in questions. And one of the questions that I frequently get in regards to 1031 exchanges involves will doing a 1031 exchange with a family member, like a brother, sister, mother, father, whatever, cause some sort of problem with the IRS? Or are there any special things to do
Sure.
to be aware of those kinds of things?
Sure. If it's a close family member and they're listed out, there are restrictions. So if you're just sort of, you basically have to, the family member has to hold the property for at least 2 years. So if one thinks, I'm going to do a 1031 exchange to the family member, and then they're going to turn around in a month and sell it, that won't work. Then the actual gain gets retroactively recognized by the original owner. So yes, the family member, so if you said a brother or child or something like that, they have to hold it there's a 2-year holding period. So if they dispose of the property within 2 years, then you lose the whole benefit of the exchange.
Okay. Anything else you'd like to comment about 1031 exchange that we haven't talked about that you think is vital to know?
Well, one of the things is a lot of times people want to use, let's say they're in a partnership that owns a building. You cannot the partnership itself is not considered real estate and can't be used as in a 1031 exchange. The partnership interest is not allowed to. But a lot of times, let's say people are in a partnership with an appreciated property. They can distribute the actual property as tenants in common to all of the partners, and then as a tenant in common, you can then do a 1031 exchange for your portion of that property. So that's a number of things. Now, things like stocks, bonds, those type of things, not eligible for a 1031 exchange. Inventory, and let's say you're a developer and you have some real estate and you've held on, and that's your business, then that is not eligible for 1031 exchanges. So, and there's no limit. Let's say if you have 10 properties and they've all appreciated, you could do 10 separate 1031 exchanges. And then the final thing I'll say is that let's say you have one property and you want to exchange it to two properties, you're allowed to do that. Or let's say you have two properties and exchange it for one property, you can do that as well. The most important thing is that you can't take money out. You can't take what's called boot out. Once any money or anything comes out to you, then it's taxable. So you really need to use these accommodators. They know how to structure the deal so that you can have this. The one other thing I can say is that generally, if the old property's market value is less than the new property, then everything will be okay. There'll be no taxable effect. There could be a very small amount that's currently taxable due to some expenses or other payments that have to be made. But generally, it's that usually works out. The one exception is if you're giving up. If you have a large mortgage on your old property and you're not going to have a mortgage on your new property, that could give rise to taxable income, even though you're not getting any money.
Mm-hmm. One thing that occurs to me, that is there a limit to the number of 1031 exchanges one can do per year?
No, that's what I'm saying. If you have 10 properties and you want to transfer those 10 properties into 10 new properties, you can do that. Okay. No limit. Yeah.
Great. Well, thank you so much for talking to us about 1031 exchanges. It's been very enlightening.
My pleasure. Thank you.
If you would like to know more about 1031 exchanges, please go to the link you'll find at the end of this program. Thank you for listening to Cal CPA's Financial Empowerment Program, which was produced in July 2014. If you would like to comment about our show, have a question for a CPA, or would like to suggest topics for future programs, write us at financialempowerment@calcpa.org, or simply visit www.calcpa.org. You can search there for a California CPA who can help you save on taxes, better manage your investments, or budget for those rainy days even sunny California sometimes has. Just click on the Find a CPA link. This is Bill Spaniel, and you've been listening to edition 165 of Financial Empowerment, a production of the California Society of CPAs and Cal CPA Institute.